and gold made the highest high on record, right around $30 shy of that elusive $3,000. And that's a key benchmark. Any of those big numbers, 1,000, 2,000, 3,000, are going to be key psychological levels. The interesting thing is when we look at gold, and I'll compress this chart, ever since we hit the all-time record high back on October the 30th, we traded lower and sideways for a while. But once we broke above that, and that is this key point right around here, you can see gold really took off with a fever.
Gold recently hit its highest price on record, within $30 of the key $3,000 mark. These large round numbers, $1,000, $2,000, and now $3,000, serve as critical psychological benchmarks for investors. Since reaching a record high on October 30th, gold initially moved sideways before breaking out and surging upward. Once it surpassed a critical resistance level, its price accelerated rapidly. Now, gold is uncharted territory, with its value per troy ounce at an all-time high and edging closer to the $3,000 milestone. The speaker, Gary Wagner, a well-renowned precious metal expert, explains that gold has experienced a strong rally, gaining $370, 14%, from mid-December to its recent high. This upward momentum reflects a solid market trend. Gary Wagner uses different charting techniques, such as the Heikin-Ashi chart, to help smooth out price movements by adjusting how openings are calculated. Unlike standard candlestick charts, Heikin-Ashi charts show continuous green or red trends, making it easier to spot strong rallies. Both chart types confirm a solid upward trend, with gold rebounding after briefly dipping below $2,600 and then moving higher. Gary Wagner says that predicting gold's long-term price movements is challenging, but short-term trends are more straightforward to analyze. While a pullback or correction is expected, gold's rally since mid-December has remained strong, with only brief dips. Notably, there haven't been 2 consecutive days of lower prices, indicating strong bullish momentum. Heikin-Ashi charts help assess trend strength by highlighting body size and the absence of lower wicks. A lack of lower wicks signals consistent upward momentum. Around January 30th, gold saw significant price growth, picking up steam after a quiet period following the inauguration as new executive orders were issued. Before diving into the video, subscribe and hit the bell icon so you never miss our latest uploads.
Market move up. And in terms of the rally itself, this rally has witnessed gold gain from the middle of December to the high that came in this week of about $370. That's a 14% rise. That is strong. Now, this is what I said is standard candlestick chart. If I convert it to what's called a Heikin-Ashi, and a Heikin-Ashi just draws the candles a little bit different. What we look for in this, the difference between these two types of charts is how the open is fixed. On a standard bar or candlestick chart, the open is fixed on the true opening bid, opening price. On this type of chart, the open is fixed from the midpoint of the prior candle. So on a weekly chart, this open represents the midpoint of the previous week. What that does is really smooth this out so that you don't get the scenario where you see red and green candles, but you'll get solid green or solid red. And so we'll go ahead and convert it back into a standard candlestick chart. And what's interesting is that right now, what we're witnessing is where these two charts are showing solid green. This has been a strong rally. This is a new leg, and it followed the correction that we saw with gold trading down, just breaking below 2,600 for a brief moment, and then trading sideways, moving back up. Yeah, this is very strong. Easy question to answer because in my opinion, we will see some sort of a pullback or correction. We typically do. However, we haven't. And if you look at this entire run from the middle of December up till now, there's really only been brief periods of about a day back on Friday, January 10th. That was followed on Monday by a lower day. That's this red candle here. Here you have almost an inside day. Here you have a day in which it sold off for 1 day and returned, 1 day and returned, 1 day and returned. In other words, with the exception of right at the beginning of this rally, we have never had 2 consecutive days of lower pricing in gold. So the fact that we have a lower price today is not enough information to say that, yes, this is the beginning of a correction. We would have to see follow through, and even 2 days wouldn't give us enough information because we've seen that before, and then it went right back, it kicked right back into bullish momentum. Mm-hmm. And that's why I like to view these candles through Henkinashi, because this is the best way to see strength of trend. And what we look for is body size and the absence of lower wicks. The reason we look at whether or not these candles have a lower wick is what it is saying is when there is no lower wicks, it says that at no time during the trading session did prices go at or below the midpoint of the prior candle. And that's a strong statement when we look right around January 30th, the end of January. The candle sizes really boost up. And when we think about it, that's 10 days after the inauguration. So we saw gold kind of get very quiet just following the inauguration. And then as the executive orders began to fly,
Gary Wagner highlights that the long-term bullish outlook for gold remains strong, but the Federal Reserve's actions will depend on economic data. This week, key reports like the Consumer Price Index, CPI, and Producer Price Index, PPI, will help determine if inflation is rising. Market participants closely watch inflationary pressures, especially as new tariffs take effect. Since tariffs can lead to higher prices with a delay, any significant uptick in inflation could force the Fed to adjust its policy, potentially shifting the current market outlook. Gary Wagner also exposes that silver has not performed as strongly as gold, which has reached multiple record highs this year. While silver recently peaked at around $33, it remains far below its all-time high of $50 from 2011 and 2012. Gary Wagner suggests strong resistance at $35. Silver has yet to challenge higher levels like $40 or $50. Unlike gold, which is seeing heavy investment as a safe haven asset, silver's price is influenced more by industrial demand, which has been moderate. As a result, the outlook for silver remains cautiously bearish. Now, let's jump into the interview.
I think it reinforces the long-term bullish case, but realize where the Federal Reserve is concerned, it's data dependent. So we have the CPI coming out later this week. Mm-hmm. We have the Producer Price Index, the PPI, coming out later this week. And what market participants are going to focus on is whether or not they're seeing any uptick in inflation, because the greatest fear from levying tariffs, which are just starting to hit, there's a lag between when they're implemented and when we as consumers see differences in the price we're paying for goods, but whether or not that translates to inflation moving higher. Because if that happens, the Fed's going to have a patience, but they're also going to have to be ready to react to any real upticks in inflation. And since tariffs really evoke the possibility of inflation heating back up, that's what everybody is going to be waiting for. And that's what could change the narrative from what we're looking at now. Would be a dramatic change in inflation. Silver is not that it's been hard to predict, but this is a daily. Let me move this to a weekly. Yeah. It's relatively speaking, I still am bearish. I mean, it certainly hasn't performed like gold has, where what we saw in gold was moving to record highs and then breaking those highs. I think gold has hit 7 all-time new record highs this year alone. But you can see it peaked out around 33. And when we pull this chart back, we can see that that's higher than silver has been for years. And we have to really go back to the other historical time when both gold and silver did miraculous things. And that was middle of 2011 to 2012. And this is when silver topped around $48 to $50. We have not seen it. When we look at this price, the highs that came in, well, as recently as November, that matches these tops that came in between 2012 and 2012. There's hard resistance at 35. It hasn't challenged 40 or 50. So if your question is, am I still bearish on silver? I'm still cautiously bearish. I haven't seen any real moves in silver that have challenged any of the recent highs, although it took out a high of $34. But even that is still below the all-time record high of $50. Mm-hmm. And so I cannot be as bullish on silver as I am on gold, because gold is definitely reacting as a safe haven asset, and investors are flocking to the precious yellow metal. They're not doing the same with silver. Silver has an industrial component that's greater than gold, but we can see that that's been tepid at best. It has moved silver from $18 to $35, and it was sitting at 18 in August of 2022. So that's almost a doubling of price, and that's a substantial move, but still below any of the key all-time record highs that we saw a few decades ago.
Gold continues to surge to record highs, driven by strong investor demand and market momentum, while silver lags due to weaker industrial demand. With key economic data and Federal Reserve decisions on the horizon, the direction of precious metals will depend on inflation trends and broader market conditions. How might upcoming inflation data impact gold and silver prices? What factors could push silver past its current resistance levels?